Howdy, Jacob here. Today we're looking at Charles River Laboratories International in the life sciences, tools, and services industry. 10.4 billion market cap on 12.6 billion enterprise value. Founded in 1947. They provide drug discovery, non-clinical development, and safety testing internationally, or I guess globally, I should say. 1.3 billion in revenue in 2014 to 4.1 billion in 2023, with double-digit compound annual growth rate from 2016 all the way to 2023. That's impressive. Gross margin at 36, 37%, very consistent, but not crazy impressive. Honestly, the operating margin, as high as it is in relation to that gross margin, is pretty impressive, 15, 16%. They don't pay a dividend, huge increase in earnings per share. Return on invested capital is okay, upper single digits. See if they got a lot of R&D spent. No, not a lot of R&D spent here. Just cost of goods sold, really digging into that profit. Cash and cash equivalents of 277 million with zero short-term debt, 2.6 billion long-term debt. So if we look at about 2.5 billion in relation to their free cash flow, it is over 5 years. So they do have a good amount of debt. And it looks like in the most recent rolling 12 year, they paid it off. But outside of that, there's only been 1 year where they've paid off more debt than they've issued. And so, although their free cash flow has grown a lot, their capital expenditures have also grown very heavily. And that could be partly due to reinvestment, partly due to acquisitions. But I mean, their free cash flow hasn't grown quite as much as their debt. And so they do have a good amount of debt in relation to cash flow, much more than, or a bit more than 10 years ago. However, I do think I'm ready to make some assumptions. I think we're going to get a lot of growth here. I think this life science tools and services industry is a pretty impressive industry of the past decade, and I think I could easily see it enter into the future. So I think 7%, because again, I have to limit out what they've done in the past with all the acquisitions and reinvestment to go into debt for that, to now allocate maybe 20 to 40% of free cash flow to debt reduction. Because if you have over 5 years of your free cash flow, your average free cash flow in debt, that's a figure that a lot of debt people are going to be a little bit scared about. I think most debt issuers look at debt to EBITDA, but as you've heard mongers say, it's BS earnings, and so free cash flow is the true lifeblood of the business. That's why I relate debt to free cash flow. But anyways, margins 11, 12. I think that's easy does it. Buybacks, they do buy back some shares. I'll say they buy back enough to offset stock-based compensation. So that's just flat. That's using 20% of free cash flow for that. They don't pay a dividend. It's mostly just acquisition, reinvestment. And again, I'm saying a bit to debt reduction because they do have as much as they have. Good margins, pretty consistent. I'm honestly fine with an 18 multiple here. And no dividend. I like companies that reinvest back in themselves. Obviously, return on invested capital isn't fantastic, but I do think that the growth rate is well above market, even at the end of 7 years. So for me, it has to pretty much drop in half before you get the return I'm looking for here. I think really the only thing I'd be looking for here is just a better return on the money reinvested back in the business. Outside of that, everything else I'm really liking outside of the price. I hope you enjoy the video and have a great rest of your day. Thank you.